Alright, good day. My name is Benjamin Christian. I'm taking you briefly on economics. The topic is company. Company. Now we all know that when we talk about company, we're talking about business, but it's of different level. Now we know that company is a business, all right. Now when we say business, we have different categories of business, all right. We have different kind of business, different categories of business. We have, specifically, you're looking at company. So we can define company as a legal entity whereby a group of individuals come together to own a business. And you can say company can be simply defined as a legal entity whereby a group of individuals come together to own a business. When we say legal entity, it means that it is approved by government. Now, for you to start a business, to start a company, it must be approved by government. All right, you can start a business, you can start supervisorship business, you can start partnership business, but when it comes to company, it must be what approved by government. That's what it's called what legal. When we say divine, when we say divine, something that is come from God. When we say legal entity, means that it is approved by government. Okay, it is approved by government. So we say that we say define company as a what legal entity whereby a group of individuals coming together to own a business. So we have what we call types of company. Okay, now we have to I just want to focus on specifically few areas. Focus specifically few areas. When we say type of company, say types of company. We have two. We have limited. We have limited liability company. Then we have unlimited liability company. We have limited liability company, then we have the unlimited liability company. Okay, now when we say limited liability company, it simply means that the liabilities of the owners has limit. The liabilities of the owners has what limit. Liabilities of who are the owners? The owners are known as the shareholders. Owners are known as what shareholders. It simply means that the liabilities of the owners has limit. That's called what limited liability company. The liability of the owner, if the business run into loss or liquidation, the owners are not held responsible. Then we have what's called the unlimited liability company. Simply means that the liability of the owners has no limit. The liability of the owners has no limit. If the business run into loss, the owners are held what responsible. Are held responsible. So it's a liability. What is my liability? It means debt. Liability means what? Debt means what there. Now, before ever we look at that, okay. Now we said that we have also what we call kinds of what company, kinds of limited limited liability, limited liability, limited liability company. We have kinds of limited liability company, which is two. We have private limited liability company known as LTD. Then we have what we call public that was called public limited liability what company. We have private limited liability company. We have what we call PLC, which is kind of public limited liability company. Known also ends with what PLC, also ends with PLC. Now, these two are private limited liability company, as name implies, it doesn't mean that it's owned by government, but just that they have limited ownership. They have limited what ownership. They have limited ownership. Why does not have limited ownership? For example, now private limited liability company, the ownership is from we have two towards okay, we have two toward 50 ownership. Then this we have what we call seven toward infinity. Does not have what ending infinity. Then partnership business ownership is from what? is from 2 to what 20, while sole partnership business is from what is one person. So partnership own sole partnership business is one person that is own it. Then partnership business is owned by 2 to what 20 persons, while the private limited liability company is owned by what 2 to what 50, while the what public limited liability company is what owned by what 7 to what infinity, does not have what ending. The ownership is what infinity, does not have ending. Okay, now when you say private limited liability company, what comes to your mind? Private limited liability company. It means that the liabilities of owners has limits. The liabilities of owners has just come what is private limited liability company. That is why the ownership is from what 2 to what 50. The liability of the owners has limit, and in this area the liability of the owners has no limit. That is why all banks are what PLC, all banks are what PLC. Okay, why the liability of the owners has no limit. If the business run into loss, the owners are held responsible to offset that debt, and that is just it. And that is another unique difference is that if you look at the private limited liability company, they are restricted by law to sell shares to the public. They are restricted by law to sell shares to the public. If you have to sell shares to the public, you have to sell shares to the public. What they do, they are not allowed to. They are not allowed. It's PLC that is allowed to sell shares to the public. If they want to, they can only sell shares between their membership, between their membership. And another thing is that another in this area is that for a member to sell share to another member, they have to notify others. For a member to sell share to its own member, they have to notify others. Yeah, you can just sell it without notifying others. So this is LTD, while this is what PLC. That is why all banks are what PLC. All banks are PLC because the liability of the owners has no limit. Why we have group Dangote Group company, they are what limited. The liability of the owners has limit. So to the amount of money invested as capital, liability of the owner has limit to the amount of money invested as the capital. Now we say shareholders. Let's look at the shareholders first. Let's look at I said we said that partnership business is from 2 to what in ownership range. In ownership range, partnership business is from 2 to what 50, and sole partnership business is one person, while the private limited liability company is 2 to what 50, while the PLC is what 7 to what infinity. Okay, now let's look at one very important area of what you're looking at. Very important area of what you're looking at. Let's look at when you say shareholders, what comes to your mind? Shareholders, shares. Then we have the holders, shareholders, shareholders. So when you say shares, simply means your individual portion of a company, your individual portion of a company. If a company is owned by ABC, they are the shareholders of the company. So when you say shares, simply means your position in the company, your position in a company. You're a part owner of a company is what's called shareholder. It's called shareholder. And we have different kinds of shareholders. I don't want to go into that. It's a topic on its own. All right, topic on its own. But I'm going to give you a clue what you are talking about, a clue of what I mean. When you say share, share, it simply means your portion in the company, the capital invested by you in that company is just called your position, your shareholder. That's called shareholder. All right. And so the funny aspect of it is that the real owner of a share, or the real company of a company, they are known as ordinary shareholders. The real owners of a company, they are known as what we call the ordinary shareholder. So we have different kinds of shareholders. That's what we call shareholders. So say shareholder, say you're referring to one company. Okay, then let's look at another important area is how to register a company. How to register a company. How do I go about registering a company? So we have what's called procedures to register a company. To register what a company. Say the pro, procedures to register a company. Register a company. Okay. So we have fine. You want to own a company. You may be having the aspiration to own a company. It's very simple. It's very simple. Number one is that for you to own a company, you must have a lawyer. You must have a lawyer, backed up with an accountant. You must have an accountant also. Now, the three documents are required by the body established by law to register a company is known as what we call company. It's known as what we call company Allied Matters Act. Company Allied Allied Matters Act. This body authorized by government to register a company. This body registers company. And before the body register your company, I think that the company is called Company Allied Matters Act. It's act because the law was made, the body was established during civilian rule. If it is degree, that means the law was made during military regime. So it's called Company Allied Matters Act because the law was the constitution was formed during civilian war, which is the act of parliament called act. Okay, now before this body establish your company, or before this body gives you the go ahead momentum to start a company, is that you must present three documents. You must present what? Three essential documents. Three essential documents before this body establish your company. We're looking at procedure to register what? A company. So you must have what? Three documents. Number one document you must have is what's called memorandum. Memo what? Memorandum of what? Association. Association. Number two, we have what we call article. Article of association. Article of association. Then number three, we have what we call what? Prospectus. Okay, these are the three documents. Number one is what we call memorandum of association. Number two is what we call article of association. Number three is what prospectus. Now you must present each of these three documents before ever this company Allied Matters Act is register your company. Number one, memorandum of association. This document states the external rules and regulations governing the company and the world public. The external rules and regulations that is governing the company and the world and the public. In other words, it states the rules and regulations, or it states the guideline that governs the company and the public and the world public. These are the things. For example, now the things that you see in that memorandum of association is the head office. Is what? Number one is what? You are looking at the word head office. Where the head office is, the head word office. Number one is therefore head office. Number two, the name of the what? Of the company. Name of the company. How dividends are shared. How dividends are shared. How dividends are shared. How dividends are shared. Okay, and etc. All right. So these are things that you see in that one memorandum of association. Number one, head office and sub office. For example, now if anything happens, or if you buy a product and the product is not is damaged, or the product is harmful, or the product does not fit to what you describe, or the product is you have an office that you can run to. That is the essence of this called head office. So in that memorandum of association, it indicates the head office of the world organization. It indicates the head office of the world organization. It indicates the head office. Number one, name of the company, name of the company, name of the company, name of the company. Is the company answering ABC? It must be stipulated, it must be boldly stipulated that look, this company is owned by what? ABC. Was owned by what? ABC. So the name of the company must be what? There in that memorandum of association. And that's what called dividend. Now, what is not dividend? Dividend are profit given to what? Shareholders. How to share dividend? In accounting, we have what we call ratio. We have what we call what? Ratio. We have what we call ratio. In account, how we share dividend profit shareholder. So for example, if I say we have number one, we have number two, then we have number three. Okay, and we say that want to share ratio. We say that if this person has 30% shares. This person has 20% shares. One person has what? 10% or shares. It simply means that this plus this is 60%, right? 60% what shares. You can say, okay, we can use 3 is to 2 is to 1. That means that if person has 30%, which is 3 ratio, if person has 20%, which is 2 ratio, if person has what 1%, which is 3 what ratio. All right. So you can say that we say that we want to share this thing now. Simple. You can say what 60 what percent times what times this giving us what is giving us this, right. You say times what times 3 divided by 6. That whatever you have is for this person. We can come again say what 60 what percent times what times 2 times 2 divided by what 6. Whatever you have is for this person. You can say 60% times what times 1 divided by what 6. Whatever you have is for, that's how we share what is. In fact that from your calculation, you find out that this person will have the highest what share. Okay, so these are shareholder. We have shareholder 1, shareholder 2, shareholder 3. So we should talk about dividend as share. So in this organization, it is called out dividend as share to shareholder without issues. It's without issue. It's called out dividend as share to shareholders without an issue. Okay, using accounting ratio. How dividend as share. In accounting, in a company, the person that have the highest share have the highest say. Person that have the highest share have the highest share, have the highest say in the company. That's how it is. That's how it is. Okay, so we have dividend. So dividend is profit given to shareholders. They are entitled of their profit. It's called dividend. Okay, another thing again that is there again is what they produce. Eh? Their nature of production, what they produce. So we have this is 1, this is 2, then this is what 3, then this is 4. Then he said they what they produce. What they produce also is there. What they produce or they sell, what kind of thing they produce, what they sell, they are all stipulated in that memorandum section. If you observe, Dangote started with what you call sugar, and but today he has so many companies, he has so many areas of set of company is working. He wants. So what happened is that at every point in time, move from one sector to another, he upgrades his memorandum. That's what he does. That's what he does. Sorry, that's what he does. For example, now if he was known for sugar, from sugar went to cement. Started cement. What happened? He has moved from what? From sugar to cement. He have to upgrade his what? His memorandum. That's what it is. So keep on. So you are allowed to move to other sector. All you have to do is just to upgrade your memorandum. Because every memorandum talk about what you produce. So if you are moving from other production, you have to upgrade that area. Then we have article of association. So all these things are under they are under they are all under what you call under memorial association. Let's look at what you have under article of association. Hmm? Let's look what we have under article of what association. Under association, it's all about the company internal rules and regulation. The memorandum talk about the company external rules and regulation. Take note. Then but article association talk about the company internal rules and regulation. The company internal rules and regulation. Okay, every company has internal rules and regulation. Number one is that okay, number one can be their addressing code. You know, in some organization, a lady cannot put on trouser. All right, that's their company law. In some organization, you're not allowed to have a relationship with your coworker. The kind of relationship that exists between coworkers is there. So as I was saying, we're talking about prospectus. Say prospectus shows the value of a company. The value of a company. Every company has a prospectus that talks about their achievement so far, as it is, how they achieve, what they can have, what they can be able to give to the society, their capability and the disability. These are all there in their prospectus. Okay, and that is why before ever you invest in any business, invest your money in any business, you must go to the prospectus, and it's always written in accounting terminology. That's why you need an accountant that will go through it and tell you that you invest or not invest. Before ever you invest in a company, take note, you must go through that what's called prospectus that will tell you about the company achievement. If the company is liquidating, are they going down or you're making progress. Okay, so these are things that you must go to before you embark in any company. You must go through their prospectus. See whether the company so far has made progress, the company so far has made achievement, the company has an expanding record, then you can invest your money. If not, your money is gone. Money is gone. Especially when it is LTD, which is liability of the owner, has a limit, money is gone. Okay, so but after fulfilling those three criteria, after bringing your memorandum of association, your article of association, your prospectus, the body issue you two documents. When you talk about when the company is LTD, which is what when the company is what it is LTD, we not call what limited liability company. When it is a PLC, a public PLC, we have the PLC, we have the private. Okay, so when it is private, the company issue you, when it is private, the company issue you, the body issue what we call incorporation of trade. Incorporation of trade, it allows you to, they give you the right to carry out a business, carry out a business. So when after fulfilling this trade document, the body issue what we call incorporation of trade, it gives you the certificate to exercise your business, carry out a business. But when it comes to PLC, the body gives you two documents, corporation of trade and incorporation of trade. So the corporation of trade gives you gives you the ability or gives you the go ahead to carry out the business, while the incorporation of trade gives you the right to give loan, the right to sell shares to the public, and that is why the private limited liability company, the private limited company, they are restricted. They are restricted by law to sell shares to the public. That's why they are restricted. Why? Because of this what I'm talking about now. Because they are only issued what they call corporation of trade. Why they were the PLC, they are authorized by law to sell shares to the public. Now, the PLC is not that it's called PLC because it is owned by government. It is called public limited because it's owned by government. No, the PLC is not called public limited liability company. When you say public, normally when you say public it means government. When you say private it means individual. Okay, but in this area, in this perspective, when we say private, it's not that it's owned by private individuals. No, you understand what I'm saying? But it is restricted by law. It is restricted by law to sell shares to the public. That's why it's called what? Private limited liability. It is private. It's not public. It is private, not public. That means that shares are sold between the shareholders. They have a restriction, they have a limit. Okay, but the PLC is called what? Public limited liability because they have the authority, they are authorized by law to sell shares to the public. Not that you are owned by government. No, it too can be possibly owned by government, can possibly owned by what? Private individual. In fact, we have company like NPA, company like Railway Corporation, company like these are companies owned by government. Okay, then we have Dangote Group of Company. They are also company owned by private individual, not that it's owned by government or that it's owned by that's it's corporate. No, let's correct that fact. Okay. Then let's look at what we call the differences between the LTD and PLC. What are the differences? I write it down so that we can have a clue of what I'm saying. All right. I don't want to just talk and at the end of the day, there's no. So let's just look at what differences. Number one, ownership structure. Ownership structure. The difference is that limited liability company or members is what limited numbers of shareholders. Numbers is what limited. In the aspect of what limited liability company, it is owned by what? Take note, it is owned by what? 2 to 50 persons. That is ownership strength. 2 to 50 persons. That is what I'm saying. But look at the difference. Ownership structure. Limited liability company, it is what limited owners of shareholders, 2 to 50. That is ownership structure. They are owned by what? 2 to 50 owners. While the what? PLC, public ownership, shares traded on the what? Stock exchange market. Now, what is a stock exchange market? Stock exchange market is also a market where you buy and sell shares. Okay, buy and sell shares, second-hand property, second-hand shares. But now if I want to buy any shares, I'll go to stock exchange market. Another example of stock exchange market we happen to call the bank. Bank is stock exchange market where you can buy and sell shares in a bank. So bank can also be seen as stock exchange market. Stock exchange market is a market where they buy and sell shares also. Okay, so ownership strength from PLC is from what? Is from 7 to what? Infinity, no ending. 7 to infinity. That's see that the ownership strength varies. Okay. Then let's look at number two, shares trading. They say the shares cannot be public or traded. They are restricted by law to sell shares to the public. They are restricted. Okay, they are not traded. Shares traded. In LTD, the shares cannot be traded. They are restricted by law. That's what I said. So I just said this. I just wrote this thing down just to give more light on what I've said. Almost throw more light on what I've said. I've said all this thing previously just to give more light on what I've said. Share traded in LTD, they are not restricted by, they are restricted by law to not sell, they are restricted by law to sell shares to the public. While the PLC, they are not restricted by law. They deal with the public. They deal with the public. It's more public or owned. They are owned by the public. Okay, then capital or raising. The minute a company raise capital, you cannot compare PLC to LTD. Why? Membership strength varies. The more shareholders, the more money. Whenever they need more money, they just sell shares to the public and public invest, they get more money. Whenever they need money in LTD, they sell shares to the members. That's the members, sell shares to the member. So you cannot compare the ownership strength. The more they sell shares to the public, the more they get more. So in terms of raising capital, uh, PLC gets raise more fund than what? Than capital. But now the pattern is that the PLC sells shares to the public to raise more what? Fund. You understand the point? The PLC sell shares to the public to raise more what? Fund. But the LTD sell shares between their members to raise more fund. To raise more fund. So PLC gets more fund better than what you call LTD. Because the two are different. One is restricted by law to deal with the public. One is authorized by law to deal with the public. Okay, then we have number four, we have regulatory requirement. PLC requires too much documentary system, all right? But why? Because they deal with the public, they deal with public fund, they deal with public, all right? That is why it requires more, it require more documentary and everything. Okay, we're looking at number five, transparency. They said it requires less transparency because they don't deal with the public. That is why annually, PLC company publicize their account financial statement to the public. If you go to magazine, you see financial statement of PLC companies, all the companies' financial statement annually. They give their report to the public because they deal with the public. The public want to know their money, how their money has been spent. The public want to know what and what is entailed. The public want to know how the money is, is money, company is making profit or not. Why? Because they expect their dividend. As a shareholder, you invest, you must expect your dividend at the end of an accounting year. Okay, so if the business is not making profit, you know that it's not making profit, so what you will trip. Okay, so they must publicize their account annually to the public for the public to be aware of the financial stability of that company. Okay, because it's owned by the public. In other words, PLC is owned by the public. Okay, then we have to go in the similarities between limited and PLC. There are so many similarities, but one is a separate legal entity. The owners, according to the law, the company sees a company as different entity from the world business. The company, look at, for example, now look at the owner, which is A and AB. Let's say, for example, now is owned by what? Blessing what? Company. All right. Government sees Blessing as human being. Government see the company as what? Human being. Government see company as what? Human being. It's owned by Blessing. Why? The company is a legal entity separated from its owner. All right, that's called separate legal entity. A company is seen as artificial human being that has a right to sue and be sued to court. And that is why if you have any issue with a company and everything, and you're a company, you have any issue, you different set and everything. All right, a lawyer will stand on behalf of the world of the company when it comes to court. Okay, a lawyer will stand, not the owner will stand. A lawyer will stand. Why? Because if the government see the company as a artificial human being that has the right to sue and be sued to court, and that is what happens here. Okay, that's what we are saying. Number one is a separate legal entity. The company is of different human beings. different human being. Why the owner is different human being, and that is why a company has a lawyer that will stand to defend the company when it comes to issues. Okay, and that is how it is. All right. So, but so both company has a lawyer. Both company is a legal entity. The legal entity. Then we have governance. We have what we call governance. Now, governance, understand, the owners of a company, they are known as share. They are known as what? Shareholders. They are known as what we call what? Shareholders. Shareholders. Now, these shareholders appoint board of directors. Appoint what? Board of what? Directors. Board of directors are also owners of the world company. Also owners of the world company. So they are known as what's called board of what? Board of what? Directors. Okay, we have board of what? Directors. Board of directors. The board of directors are members of the owners of the company. But if an example of a company that like PLC company that is from what is from seven to what infinity, it's not all the 100 shareholders that will come and make laws. No, there are point members of the shareholder that will make decision on behalf of the entire members. This board of directors are appointed by shareholders to make decision on behalf of the owners, because the total number of people cannot come out and defend the come out and make policy concerning the company. All right. So there must be some amount of members that will come. That members that will come that represent the shareholders, not got board of directors. In other words, the board of directors are also members of the shareholders. Board of shareholder. So all right. So that's called the governance. The governance they are being governed by board of directors of members of the shareholder. The board of directors appoint what we call the MD, the managing directors. All right, about the managing directors to manage the business. Okay, the managing director and other sectors, they are all appointed by the board of directors. So the board of directors are members of the shareholder that appoint that is being appointed by the total number to make decision on behalf of the company. Now, the board of directors is the same as the shareholders. They have been appointed. Okay, the board of directors now can appoint the managing directors to manage the business on behalf of the company. Then we have what we call financial reports. I've said it already. The board the board gives financial reports. The board has to give a financial report based on financial, where specifically it has more effect when it comes to PLC, where to give financial report every year. Then we have taxation, both pay tax, we have company tax. We have company tax. At the end of this year, every month they pay company tax. We have very high tax. So they are company. So we have company tax. They pay tax, and that tax is 1% of your income. 1% of your income. That is tax for you already. So we have operation, business operation. So both operate legally. Both operate legally. They are legal entity. Then registration. I told you before registration. The registration is same thing. The both are registered under what Company Allied Matters Act. The two companies are registered under what Company Allied Matters Act. Okay. Then we have the memorandum and article. The two have the same memorandum article. But memorandum, the two is that the memorandum is that internal rules and regulation, it states internal rules and regulation, the kind of thing that you're supposed to see. For example, that the shareholders, who are the shareholders, who are the board of directors, what is the name of the company, how to share dividend. They are all stipulated under the memorandum of association. Also under the memorandum of association. Then we have the article. Article talks about the company internal rules. So this external rules, why this is what internal. I give example. For example now, if you want to move from one settle to another, all you have to do is to upgrade your memorandum. I use Dangote Group as an example. Dangote was known as sugar, from sugar to other sector. What happened? Current year is almost in all area of sector. What you do, as time goes on, and whenever you want to introduce new product or new sector in his business, what you have to upgrade is your memorandum. That is what happens. Okay, memorandum. Why? Because it states the things that you are producing or you are selling the head office, all these are there. All the article, as we have discussed so far, talks about the company, the company or internal rules like relationship that exists between co-workers, understand, the dressing code, when to come to work, and all those things. What's your restriction? This is your do's and don't in that company. All right, it's all there in that article of association. Like how we have also yesterday. So the prospectus also, so that the ability of the company, ability of the company. Then we have what we call the so after set and done, after you have fulfilled, take note, after you have fulfilled these three documents, all right, the next step is that the company other matters act give you the authority or give you the right to exercise your business in the labor world market, labor market. So the business labor market. But in the area of LTD, they have restriction. I've told you before. While in the area of PLC, they are giving you right to exercise business with the public. Okay, then we have director and shareholder. Director and shareholder. Okay, I told you already. The director and shareholder, they are still members of the world owners. Okay, member of the owners. Director, the board of director is still the same thing as what shareholders. Okay, two are still the same in terms of PLC and in terms of what LTD. They are work together. Okay, now let's look at some area, understand, for more clarification. Okay, now if you look at this, if you look at this very well, if you find out that recently when the MMM came into play and so many people invest their money and we keep telling them, all right, that these are companies that they are not reliable. And that's why if you log in, they tell you that invest your profit. Okay. Now let's understand. Let me make more clarification. Okay. Now, why is bank is PLC? Why bank or bank? If you look at First Bank, say First Bank PLC. If you look at UB, say UB United Bank of Africa PLC. Why is that at the extreme below? At the extreme below, you see PLC. For example, if you say United Bank, say United Bank for Africa, you see PLC. What does it tell you? PLC. It shows that all banks are PLC. All banks are what? PLC. Banks are PLC. Now you cannot compare a bank to what microfinance bank. You understand? They are microfinance bank. You understand what I'm saying? The liability microfinance can be categorized as LTD. Understand why? The liability owners has limits. Okay. In this point now, your money is safe. Whatever you invest in that company is safe. That's why it's called what PLC. It's called what PLC. So all banks are PLC. All banks are PLC. While we have some companies that are what LTD. Every company is either it's PLC or LTD. At the extreme below, at the extreme, name of the company below the extreme, you find out it is PLC or it is LTD. If not indicated it is PLC or it is LTD, know that that company is not that organization is not a company. It's either a partnership business or a cooperative society business or supervisorship business. Okay, but so that is a company, it must classify whether it is PLC or LTD. Another area of company that I didn't make more point is what we call company by guarantee and company by trust. All right, company by guarantee is almost just like this. And they are focusing this area, and as they are focusing this area, okay, fine. Now, let me throw more light on when we talk about shares. When we talk about shares, and I started to about shares. Shares. Now let's understand. I said the shares simply means your individual portion in an organization. What's your individual portion in what an organization? What's your portion as an organization? Okay. Now the amount of money invested in a company, here is your shares. Then we have what to call goodwill. We have what to call goodwill. Goodwill also. Goodwill also. The amount of money invested in a company is known as what? Capital. Known as capital. That is the amount of money invested in a company. Known as capital. Now, what is goodwill? Before ever you invest in a before ever you invest your money in a company, there's something that attracts you to that company. You can't just stand up and start investing your money. Something about that company that attracts you to invest your money. You understand? That thing that attracts you is called the goodwill. It's called what? Goodwill. All right. For example now, I'm singing. I want to sing song. I'm singing nonsense song. I'm singing. I don't have good beats. My voice is not clear. I don't have a nice voice. But once I featured lives of Davido, Whiskey, what happened? People want to buy my song because of their name. Because of their name. That's because that's what good way. Value added to the name of the company. That's called what good way. All right. So now, when you invest your money in a company, you also pay for goodwill because there is something that attracts you to that company, and that is why the goodwill simply means the value added to that company. And that is why when you invest your money, the capital is being invested in the company, while the goodwill is shared to among the shareholders, among the shareholders. Now, looking at the shareholders, I said that we have different kinds of shareholders and also look at their uniqueness. Okay, shareholders. Now, I think that the real owners of a company are known as what they call board of are known as what they call ordinary shareholder, ordinary shareholders. If you invest your money in a company, the company first of all asks you what kind of shares you want to buy. If you want to buy shares like preference shareholder, you want to be a preference shareholder, you want to be a ordinary shareholder, you want to be a naked shareholder. Now, for people that are known as called preference shareholder, preference shares, the word preference shareholder means that it simply means that they if the business run into loss, if you run into loss or liquidate, all right, the profit given to the shareholder, it will be carried over. It's called preference shareholder. It's not called they have what called number one. You know what's called what? Preference. We have what's called preference what? Accumulative preference accumulative shareholders. Then we have what's called preference non-accumulative shareholders. The preference accumulative shareholders that if the business make profit this year, if the business fail to make profit this year, the profits uh the dividend is carried over. The dividend is carried over to the next to the next period, to the next accounting period, to join together to pay the shareholder. So their dividend is being added. Whenever the business makes make profit, their dividend is being added as the next to the next month to be added to the previous one. That is what we call preference accumulated shareholders. All right, they are not preference non-accumulated shareholders. Their dividend are not added. If the business meant to pay profit, their profit is gone. Okay, not called non-accumulated preference shareholders. They are called non-accumulated preference shareholders. Their dividends are is lost, is gone. If the business meant to make profit this year, when the business if the business make profit this year, they pay them. But if you fail to make profit this year, the money is gone. Money is gone. But in the area of preference shareholders, accumulative shareholders, if the business make profit, it is added and paid in the next accounting period. Then we have the ordinary shareholder. Ordinary shareholders are real owners of a company. Okay, now let me expatiate on these four things. Four things. We have what we call shares, shares. We have what we call stock. We have what we call dividends. Then we have what we call debenture. The debenture. Let's briefly look at these areas. Three areas. The three areas. Okay. Now shares. Shares. We say that shares simply means your individual portion in your company. All right. Now stock simply means that if I have a shares like 50%, I want to sell it. I want to sell it to somebody. At that point, it has become a stock. And I've got it's for trading. I've become a stock. All you have to do, I just have to go to a stock exchange market. Then I want to sell my shares. It has become a stock. It has become a trade. Stock has to do with trade. It has become a stock. No longer about shares. All right. It has become a stock. That's the difference between shares and stock. All right. So this is for trading. It has become for trading. All right. As a share, your portion, you are trading it. So when you are trading, it comes to a stock. That is just the difference. Okay. Then we have what we call dividend. So say dividend simply means profit given to shareholders. Profit given to shareholders is dividend. Okay. So dividend is always used as area of what shareholders. Okay. Then we have what we call debenture. Debenture. Debenture has to do as an evidence, that a loan is given. So the debenture goes in line with a loan. Certificate that shows that someone is owing you or you're owing someone, It's called what? Debenture. Okay, so the four are interrelated, but they are different. So we can say that share. You can say that we can say that collective of stock, we have what we call what? Shares. Then we can say that breaking down of what? You can say a breaking down of what? Of shares. You have what we call what? Stock. How we call the stock. So if you put all the stuff together, you get your share. If you break down this thing, you get it to you get your stock. So that is it. So we'll look at we are done for today. We are done for today. We have done justice to it. We started with the meaning of company and the types of company and the kinds of company. We've emphasized critically on the PLC and LTD. Now, let me take note of that before we round up the session. Now, I told you that the two is not that the other is PLC, not that it's owned by government. No. The difference is that one is restricted by law to deal with the public. The other one is allowed by law to deal with the public. And that's why the ownership vary from 2 to 50, while from 7 to infinity. I love you guys. See you next time.